Welcome guys, thanks to an SEC filing, every 3 months we get an insight into what the super investors of the world are buying. Pubrai, Buffett, Bill Gates, Bill Ackman, Steve Eisman, and Michael Burry, and so on and so on and so on. Remember guys, that SEC filings are only as good as the day they are filed. They are released 45 days after the filing, so there's no guarantee that these super investors are still holding the stock. With that said, I'm HJGWhite, let's get into this. Starting at number 10 is United Health Group. You may or may not have heard of this company. I hadn't before I started researching for this video. When I was looking at their investor relations page, I discovered that they had 2 main revenue segments, United Health, which offers health insurance, and Optum RX, which offers sort of medical solutions. So first they're providing the medical insurance, and then they're providing the medical insurance. So they're making money in, medical solutions. So they're making money in 2 ways. They are first selling you insurance on medicine, and then they are reducing the cost by innovating medical technologies. So a really clever way to have your medical insurance business set up. It seems the largest holder of United Health Group is pwned Capital Management, who currently own a $1.2 billion stake in the business. However, they have trimmed that stake a little bit in the last quarter. Right, next up is a favorite of Charlie Munger. It's the only bank in the top 10 most owned list, and it's Wells Fargo. Charlie Munger, co-creator of Berkshire Hathaway with Warren Buffett, the largest hedge fund in the world, invested 41% of his personal fund, the Daily Journal, in Wells Fargo. So he didn't purchase this in Berkshire Hathaway, he purchased this on his personal account. I think the purchase of Wells Fargo by legendary value investor Charlie Munger is another indication, as Steve Eisman says. Steve Eisman is the incredible investor who shorted the banks in 2008 and was played by Steve Carell in The Big Short. He said in a recent interview that banks are cheap at the minute, and this purchase seems to represent that also. I'm not particularly well clued up on how to value banks, but it seems shocking to me that Wells Fargo has a price to earnings of 10. This could be in part to its sliding revenues. Over the past 5 years, it's dropped from about 100 billion in revenues to 80 billion. However, you would come to expect this in a time where interest rates are rising. This naturally makes it harder for banks to earn money. Munger's 41% stake seems to be a strong indication that he does not believe that this company is on a downward trajectory. Their income, while down over a 5-year period, is up recently, and also that combined with share buybacks mean that the earnings per share have never been higher. Thanks to this, their price to free cash flow is 6. Next up, at number 7, interestingly, is Mastercard. The biggest holder here is Berkshire Hathaway, but as we all know, Berkshire Hathaway is the largest hedge fund on the world, so it's not really surprising that they have stakes in everything, and just by having a tiny stake in this business, it happens to be the largest stake in the company. It also seems sensible to have a transaction company while inflation is doing its thing, because these transaction companies take a small percentage of every transaction, and so they rise and flow with inflation really nicely. In my opinion, Mastercard is to transactions what Pepsi is to Coca-Cola. So I see Visa really as the Coca-Cola, but perhaps Mastercard was seen as a value play when Berkshire Hathaway purchased it. However, currently they do not seem cheap. They have a price to earnings of 39. But obviously what is amazing about Visa and Mastercard is that they have extremely high margins, given the fact that they have basically no operational cost. However, for Mastercard especially, their debt has been going up, and I can't really understand why. The only reason I could gather from a tertiary helicopter flyover valuation is perhaps they were purchasing debt cheap and using that to buy back shares. Of course, if you buy your shares with cheap debt, what you're doing is actually really smart. You are getting your future incomes in exchange for some short-term cash expenditure. These share buybacks, along with its inflationary growth, mean that the revenue per share has an impressive 14% compound annual growth rate over 5 years. So no wonder the legendary Oracle of Omaha is interested. Speaking of the legendary Oracle of Omaha, next up is Berkshire Hathaway. One of the reasons that this is on the list is because Bill and Melinda Gates Foundation is absolutely huge, and they own a massive stake in Berkshire. Bill Gates and Buffett are very, very good friends and often play bridge together. Perhaps over a bridge game they discussed purchasing each other's companies. Bill Gates purchased Berkshire Hathaway Hathaway shares decades ago, but just recently they added 27% stake in the stock. I feel like a financial breakdown of Berkshire Hathaway would require an entire video of its own, so what I'm going to talk about is the main value of this business, and that in my opinion is the two men at the helm, the 93-year-old Warren Buffett and the 99-year-old Charlie Munger. The most amazing thing about Berkshire Hathaway is not its investment returns. They only return around 20% a year, which is absolutely fantastic, don't get me wrong, but it's not the best in the investing hedge fund world. What's incredible about what they've done is the length of time they've been doing it for. Berkshire Hathaway started in like the 1930s, so it's almost 100 years old, and what's incredible is Charlie Munger and Warren Buffett's investment philosophy has just proved timeless over the decades. If I were rich enough, I'd love to hold one share of this right now just to be able to say that I held the stock while these two legends were alive. However, I am slightly concerned at their age and whether they'll be around in the next decade, because I do think that the value of this portfolio will significantly decline after these two men can no longer captain the ship. Now, after Berkshire comes another Warren Buffett Berkshire stock, Visa. Visa shockingly have a lower price to earnings of Mastercard, so I'd need to do a deeper dive to understand the comparisons of these two companies. But yeah, it seems to be that Visa is cheaper than Mastercard despite being the bigger company. Despite them seeming slightly better value, investors seem to be trimming the stock a little bit. For example, its largest shareholder, TCI Fund Management, has dropped 7% of its stake. Perhaps it's just trying to diversify its assets and reduce a little bit of risk, as Visa is currently very close to its all-time highs. Anyway, Visa have much less debt to equity when compared to Mastercard, and on top of that, they have also been buying back shares in the business. This is why I think that Visa is potentially more attractive to super investors and has the higher market capitalization, and potentially why it is wound up on position number 5 on this list. Its lack of debt on the balance sheet, its buying back of shares, and its compound annual growth rate is 1% higher than Mastercard, which is why I think this stock is the better company. Next on the list is one that you will have all certainly heard of. It's Amazon. Amazon is a company kind of like no other I've seen. I don't think I've ever seen a company that seems to pride itself on making as little profit as possible for shareholders. As far as I'm aware, it does not seem to ever intend to reward shareholders, only reinvest any profits that it does have back into the company, into new innovation. The only way it intends to reward shareholders is with capital gains, which so far, I've got to say, has paid off enormously for the people that have been investing in this stock for 20 plus years. In the last 12 months, Amazon has the highest revenue that I know of in the FANG stocks. It has over $500 billion in revenue. When watching interviews with their CEO, Jeff Bezos, it seems Amazon's philosophy is you need to fail in order to succeed, and when you do fail, you need to fail fast. Then what you want to do is you need to learn and then move on, either cancel the project or change the project entirely so that it cash flows as quickly as possible. This burns a lot of cash, but it does also produce a ton of innovation. That again, in turn, over time, leads to big profits in the future. As a result of all of this, Amazon's revenues are 40% larger than Apple, the largest company in the S&P 500. Amazon are actually the 6th biggest company in the S&P 500. Apple first, and yet Amazon with 40% more revenues is 6th. This is because Amazon's profits from those revenues are 1/10 the profits from Apple. So arguably, Amazon should be 1/10 the market capitalization of Apple, because what we as investors want is profits. But don't expect this to change soon. Jeff Bezos's Amazon's philosophy is really to continue to reinvest back into the business and always focus on growth. Speaking of companies that like to focus on growth and innovation, number 2 and 3 on this list are Google and Google. Alphabet has 2 different classes of shares. I believe one is with voting rights and the other without, and that is how this company can be positioned 2 and 3 on the top 10 most owned stocks by super investors. It seems its recent share price recovery has gotten some investors perhaps a little bit worried. For whatever reason, they seem to be trimming their positions a bit. However, not legendary super investor Bill Ackman, creator of Pershing Square Holdings, who in the last quarter bought a 16% stake in the business. Despite Google or Alphabet Alphabet investing in a great many exciting businesses. Their company invested another 40 billion in research and development in the last quarter alone. Despite all of this investment, Google seems to really struggle to be known for anything other than Google search. However, I don't think investors should be worried because Google search continues to beat revenues every single quarter, and despite the emergence of ChatGPT, they continue to get revenue growth. On top of this, Google have relatively no debt, so the lack of debt combined with the growth, combined with share buybacks and all of these things mean that Google is an incredibly desirable business. That said, all this seems to be priced in. 60 billion in profits is a small slice of their $1.7 trillion market capitalization. The next stock on the top of this list seems to be priced slightly more reasonably and has seen more growth and has also exciting growth opportunities. Before we get into the final stock, I just want to let you know that either next week or the week after, I'll be doing a video about the top 10 stocks that super investors bought in the last quarter and doing a flyover of those as well. So if you want to be notified when that goes live, please subscribe and hit the notification bell. Also, please feel free to like this video as well. Okay, so what is the final stock on this list? The number one stock most held by super investors currently is Microsoft. This is partly due to the unsurprising fact that Bill Gates is a super investor himself and owns 30% of the stock. But that's not the only reason. This 48-year-old company has surprisingly incredible financial health and growth, which is why ratings agencies like Moody's have granted Microsoft the highest possible AAA rating. It has a price to earnings of 34, which is quite high relative to itself, given that its average 5-year PE is 32. However, this makes sense when over the last 5 years, their earnings have grown 200%. And not only have they grown 200%, they've done this in a relatively new sector. It was their Microsoft Cloud business that grew most in the last 5 years. I think the question is, when holding this stock at a price to earnings of 34, is will this cloud business continue to grow another 200% over the next 5 years? Or will Microsoft look at a different financial sector, perhaps AI in combination with Bing, ChatGPT and Bing merged together in order to grow their revenue in the next 5 years? Anyway, if investors holding this stock expect them to see the same growth over the last 5 years going into the next 5 years, investors will certainly see Microsoft revenues hit $500 billion by the year 2030. Except when Microsoft hits these revenues, investors in the business will likely be rewarded a lot more than Amazon investors. Anyway, that's all for the list. If you enjoyed this video, give a thumbs up. Thank you very much. See you next week. Goodbye.